Good morning and welcome to this Wednesday, September 7th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. We got the S&P 500 still clinging to a key support area between 3,900, 3,921. We'll talk about that in just a little bit. Futures overnight were down. They turned green earlier this morning and then quickly went red when the Wall Street Journal article came out talking about how the Fed is likely to hike 75 basis points this month. And of course, the market didn't like that. We saw futures turn red for just a bit. And then just recently again, I saw futures coming back. Let me see. I'll give you what the diamonds and the S&P 500 are doing currently, along with the QQQ. Diamond right now is down about 0.2%. Looks like down 60 cents, down to 311.60. The spider is currently down the same, right about 0.2%. And the QQQ down less than that, which is a little surprising. Normally, when you start talking rate hikes, normally the growth-oriented stocks get hit a little bit harder. But the QQQ down about 0.1% this morning, but still down is down. And that definitely changed the fortunes of futures this morning. But let's go ahead and I'm going to jump right in for those of you who are new. Let's jump right in and take a look at Earnings Beats. Of course, this is my home over at earningsbeats.com. If you'd like to learn more about us and follow the way we look at the market, I would highly recommend going over to earningsbeats.com and then scrolling down and subscribing to our free Earnings Beats Digest newsletter. No credit card required. You can unsubscribe at any time. Certainly won't hurt my feelings. We do this really just to give back to the community. Just a frequent newsletter article comes out 3 times a week. So it kind of keeps you in the loop, possible trading opportunities. Occasionally I might talk about the S&P 500, might talk about sentiment, could be any number of things. But we do try to provide some pretty good information in this Earnings Beats Digest. Occasionally when we do provide individual stocks, I know a lot of our subscribers do like to take positions. Of course, that is completely up to you. It's your money, it's your risk. But we do try to point out key things. And for me, when I trade, it's all about managing risk. It's not trying to be right all the time. Trust me, if you think you're just going to get in the market and be right all the time, you're going to have a lot of pain ahead. Instead, the key for me is really trying to manage risk. That's what I always talk about, whether it's calling the overall market, whether it's an individual stock. I'm always trying to manage my risk best I can. So I want to try to enter a stock. If I'm going to enter it, I want to try to enter it with the least risk possible. I think most people, many unsuccessful traders, are getting in thinking I'm just going to make a lot of money. And that's about their only thought process when they buy the stock. I think you got to be a lot more, be a lot more critical, evaluating the trade before you actually put it on, and know what will take you out of a trade before you get into it. I think that's key. And then sticking to it. Sometimes you're going to get whipsawed. That's part of the game. But one thing you don't want to do is start building big losses in positions. That's what kills portfolios. That's what changes your mentality from, okay, I can make money in the stock market, to, oh my gosh, the stock market's rigged and you can't make money. So just be careful. But anyway, this newsletter, I think, might help in some of those regards. We try to be very disciplined in our approach. And so if you're interested, you want to sign up, just go over to earningsbeats.com, scroll down, and make sure you type in your name, email address there. We'll get it out to you. Normally, we try to get this newsletter out by about 8:30 in the morning. If it's later than that, you can blame me, usually, because I'm normally just a little bit late getting it to Aaron, who then publishes it for us. But we do try to get it out by about 8:30, at least try and give you some time before the stock market opens to read it and just figure out if that's something that might impact your trading that day. All right, let's talk a little bit about the action yesterday. It's been like pulling teeth for the market to try to rebound. I think the NASDAQ now has been down 7 straight sessions, and that was since Fed Chief Powell made his comments from Jackson Hole. We have not seen an update on the NASDAQ since that day. And I think that was August 26th, Friday, August 26th. Here we are now, Wednesday, September 7th. So that's 12 calendar days, 7 trading days, and stock market hasn't seen sunshine. So I don't know. Hopefully today's the day. I can tell you sentiment is getting stretched. And it's, I've been talking about it now for the last couple of days, trading days, that is. And it's hard to say exactly when the market rebounds. All I can tell you from history is that when the market gets more and more and more bearish and buys more and more and more puts versus calls, it's like a rubber band snapping back. And it doesn't mean you can't pull that rubber band back a little bit further, but when it lets go, that's when you normally have a big rally back to the upside. And it's usually very swift. So timing it is not always easy. In fact, it can be very difficult. And usually you've got the volatility index going up when the equity only put call ratio is going up. And of course, when the volatility index is going up, the market can be dropping rather dramatically. So what we'd like to see is kind of what we saw back earlier in the year with many of these big reversals. If you think back to January, I think it was January 24th. And then again, I think right around February 24th, where we had the big down and then all of a sudden had this huge rally back. Many times that'll mark a key bottom, at least a short-term bottom. In this case, I think it could mark a more important bottom, but we'll see. Anyhow, that's what I'm looking for. I'm looking for one of those days where all of a sudden the buying, and normally it's not too hard to spot because all of a sudden you're bearish and then everything turns and goes the other way. And you're like, what the heck just happened? Especially if you're on the short side, because it can be very swift. But anyway, we're not there yet. As I said, we've been seeing the market drop over and over again. I think the Dow and the S&P went up one time in the last 7 days. So I think they're down 6 of the last 7. NASDAQ 7 days in a row. We're below our moving averages. Short term, hey, the configuration's bearish. I know I made a bottom call in June. I'm still bullish about that bottom call. I still think June holds, but you can't look at this market right now in the short term and be bullish. I mean, it's simply, you've got the PPO that's turned negative. You've got price action below the 50, below the 20. The 20 is about to cross over the 50. So we're about to get another death cross. All of these things are bearish. So short-term bearish. We're also getting very bearish in the options world. So that can trigger a reversal at any time. So what I'm doing simply is watching some key support levels. And I got a little aggressive yesterday. I sent out to members. The daily market report indicated I was in the QLD, which is a leveraged ETF on the NASDAQ. I closed it at the close just because you never know in this market. And what I've been talking about all year, we don't know how the market's going to open. And the morning has been historically the worst part of the trading day. So holding a leveraged ETF overnight, not really my thing, unless I've seen that big reversal, then I'll hold. But anyway, got out at the end of the day yesterday. I'll probably, see how things go today. I might be back in it. And I'll tell you why as we go through this session. But anyway, right now, Dow Jones Industrial Average finished down 173 points yesterday, a little bit more than half of 1%. S&P 500 down 0.4%, closing at 3908, at 3,900 to 3,921 level. That range is what I'm watching on the S&P. We went down yesterday below 3,900 intraday, did manage to close at 3,908. I wouldn't say that we had a massive rally into the close. That would be stretching the truth just a bit. But we did manage to come back up and close above 3,900. It's at least a start. We'll see whether or not the market can begin to show strength today. The NASDAQ, again, 7 days in a row down. Yesterday, no exception. Down another 86 points, down 0.75%. It, too, is right down here near a key support, right at about that 11,500 level. That's where we had gapped down before. I think we may have closed about 14 points below, if I'm not mistaken. We'll look at the NASDAQ 100 in just a minute. Mid caps down 3/5 or 0.6%. Small caps down more than 1%, about 1.33%. So pretty big down day for the small caps yesterday. Real estate among sectors, best performer, up more than 1%, but it was mostly down day for the majority of the sectors. I want you to check out communication services because we're back at the June low on communication services. This group has been very weak, not just on an absolute basis, but clearly on a relative basis. Because you can see all of the major indices are not yet back to that June low, even though they seem to be heading that way. But the XLC is already there. Energy also weak, back down below the 20-day. I didn't give you crude oil prices at the, let me see if I can pull that up for you. Usually I like to give that at the beginning of the session. Crude oil prices down about $1. So down below $86 a barrel right now. So down another 1%. I would expect energy not just to be under pressure today. I think energy is going to be under pressure going forward because right now the Fed is bent on going after inflation and to heck with the economy. I mean, that's the way you have to look at it right now. I think that's going to change, but I've been saying it's going to change for a while and it's still not changing. What's really going to be interesting today is we've got 4 Fed officials that are going to be talking. And with what's going on and the way the market's been spooked by interest rates, this has me more than just a little bit nervous. We'll see how the day goes. But we've got Thomas Barkin, President and CEO of the Federal Reserve Bank of Richmond. He's talking right now. He started at 9 o'clock. Loretta Mester, President and CEO of the Federal Reserve Bank of Cleveland. She'll be out speaking at 10 a.m. this morning. Lyle Brainerd, Vice Chair of the Board of Governors of the Federal Reserve. She speaks at 11:55. Michael Barr, Vice Chair for Supervision of the Board of Governors of the Federal Reserve, speaks at 2 o'clock. Then you got the Beige Book coming out at 2 o'clock. And that's the report that's produced 2 weeks before monetary policy meetings. And that's where one Federal Reserve district gathers anecdotal evidence of the economy from all 12 districts and then reports on it. So each one of these Beige Books, a different Federal Reserve district bank will go through all of the evidence, the economic evidence before the policy meeting. And then, of course, that's when they start developing what they're going to do. So you got all of that on the docket today. And ordinarily what I would say is, hey, there's not much economic news out today. However, I would maybe jot those times down: 9 a.m., 10 a.m., 11:55 a.m., 2 p.m. Because if you happen to see the market do something at those times of the day, it could be in response to what one of the Fed officials are saying, or it could be the Beige Book that gets released at 2 o'clock. Anyhow, all that going on. I just think with the policy right now, the global economy, it's going to be hard for the global economy to pick up. I just think demand is going to wane, demand for energy. And as that happens, unless there's some kind of a supply shock, I think crude oil prices, their path of least resistance right now is to the downside. And that is never a good thing for energy prices or energy stocks. So we'll see what happens there. Technology has been very weak. This is probably one of the more surprising things that I've seen over the past 2 to 3 weeks since we topped in mid-August. I wasn't at all surprised to see the initial top and the pullback because there were so many in the money calls back in mid-August heading into option expiration week. I felt like it behooved market makers to move prices lower. So this move back to the 20-day wasn't a surprise. It was the Jackson Hole speech and the subsequent move down. And I think that's what's gotten the attention of Wall Street here. The thought that, hey, the Fed's probably going to back off. We had some really good PPI and CPI numbers out last month. And the Fed basically came out and directly addressed that by saying that they're not looking at just one month of reports. They need to see consistent pullback in these inflation numbers before they're going to, let off the gas in terms of the rate hikes. So there's a lot going on right now. Let's just watch and see whether or not we can get this reversal. remember, the stock market prices a lot of stuff in. So I know the news is bad. The news is always bad when the market's down 20, 25, 30% from its highs. The reason it's down is because there's bad news coming. So I don't worry about the news. I think the Fed kind of threw a little bit of a curveball. I lose confidence in the Fed when they start editorializing. Just give us, are you going to hike rates? Are you going to lower rates? Don't tell us there's more pain ahead. I think that gets back to like Greenspan and the irrational exuberance, which, by the way, I went back. I forgot exactly when that was. That was in 1996. Do you remember what happened in the 4 years following 1996? After he said there was irrational exuberance, the stock market soared. So the Fed is no better than anyone else at calling the stock market. And then I'm not even sure they're as good as a lot of folks at calling the stock market. So when you start talking about more pain ahead and you start associating it with the stock market, or even if it's, I don't know, even if someone can interpret it as maybe being toward the stock market, I think that's when the Fed has overstepped what it's supposed to do. Just my opinion. Feel free to disagree. But anyway, that's when a lot of things turn. That's when we've seen the 7 straight days down on the NASDAQ and so forth. Staples also a rough day yesterday. Looking at the 10-year Treasury yield, I'll tell you what, this was to me the story of the day yesterday. 14 basis points higher on the 10-year Treasury yield. And remember when the stock market was doing really well to the upside, I'll just annotate this for you. But when the stock market was doing really well to the upside, we basically had this going on. We had interest rates falling. I mean, it was basically, whoops. There we go. It was August 15th, we topped. And guess what? It was about August 17th, we broke out of this channel. So rates came down, rates were going up, market was going down. Rates went down, market went up, and now rates are going back up, market's coming back down. So there's no doubt that there's been a pretty tight inverse correlation between the direction of the 10-year Treasury yield and the direction of the S&P 500. And now what we're looking at is, do we hold 348? I mean, we could be in for some sideways consolidation and then a drop. But if we break above 3.48, I think that is a signal that we're probably going back down to that June low. I'm not going to say break below it because I'd have to see what my sustainability ratios are looking like. But we could, if we don't hold 3,900, I think the odds increase significantly that we're going back to 36. And I didn't think that was going to happen, I'll be honest. But you got to follow what's going on in the market. Right now, technically, we're weak. And I think we're going against some pretty key support right here. So let's see how this plays out. S&P 500. There's your down. Oh, there's that one update we had, which was last Thursday. Yeah, I think it was last Thursday. Anyway, there's your down move. That was the Jackson Hole meeting right here, this big red candle. Selling all day long. Now, we have seen a little bit more of the morning weakness versus afternoon weakness since then, but that day was distribution all day long. And if we were to lose 3,900 with one of these kinds of candles, then I would say it's almost a guarantee we're going back to 36. I mean, that would be a brutal candle from this level. I don't think that's going to happen, but hey, anything can happen in the market. So there's your S&P 500. The NASDAQ, I mean, if you look at the gap support right here, let me give you this number. We had closed on July 26th at 12,086.90. We gapped up the next day to 12,299. So we're up a couple hundred points there from that close to this open. And we never went back down to this 12,086 level until the last 3 trading days. And yesterday, we closed at 12,011. So we did close a little bit below that level. So the NASDAQ's already showing some cracks in the foundation by moving a little bit below this. If we don't get a reversing candle, like a bullish engulfing candle or something right here and pretty quickly, it certainly looks like the NASDAQ, the path of least resistance, is back down to that June low. Let's take a look at the That's the NASDAQ 100, the NDX. So I thought I'd pull up a few stocks here that maybe are worth monitoring, because these stocks are obviously going to have a big impact on both the NASDAQ 100 and on the S&P 500. Apple, the biggest holding in both of those indexes, and they're market cap weighted. So Apple is the biggest component of both indexes. And you can see we've lost this gap support. We broke out right here above this top at about 155 and change. We lost that support. We actually, this hammer right on the 50-day, normally I would get in on a candle like that, and my stop would be any intraday move below the candle. Yesterday, I would have been stopped out had I been in Apple based on that, the way I would normally trade. I mean, that's a pretty good candle, that hammer right at gap support and the 50-day, and we lost that support yesterday. So again, we need a reversal pretty quickly, or things can escalate. And when you've got the volatility index on the move to the upside, the higher it goes, the faster the market can drop. That's what, if you go back and you study the VIX and its relationship to the S&P 500, when it starts to really get moving, the VIX to the upside, that's when we normally have issues with the stock market to the downside. Now, again, fear is really building. I would say this, though, we have not closed over 28 on the VIX in more than 2 months now. We've gone up. We tested it on, or nearly tested it on, probably 6 or 7 different occasions the last 2 months, but we have not closed above 28. If we close above 28, I think that would be a signal that's probably going to coincide with the S&P 500 losing that 3,900 support. And I would be very careful. For me, it would mean cash. I don't short. I still believe we bottomed in June, which changes my opinion. I was more of a bear the first 6 months of the year. Let's go back to the S&P. So back here is when I was talking about, hey, we got problems ahead. Be very cautious during the first part of 2022. And then once we started seeing price breakdowns, it was over. That's when I thought we were heading for a bear market, 20 to 30% drop. We ended up going down 25%. But at this low, money started rotating in very bullish fashion. And so at that point, I threw all of my bear strategies out the window, and I went heavily long and announced it back then, both on YouTube, my videos, and also to members. And this was a really nice bullish run. But once this happened, Fed Chief Powell and his Jackson Hole remarks, to me, all bets were off. And at this point, just kind of waiting, trying to find an opportunity for a bottom, a more short-term bottom. I don't think we go back down here, but again, anything's possible. We'll see. Play it day by day. So let's go back to that Apple chart. So Apple is struggling now. It's below the key moving averages. It's below its key moving averages, below gap support, below this price support, and it needs a reversing candle. The PPO's turned negative. If we go and we look at a longer term weekly chart, I mean, here we got up close to the recent high. We've pulled back. We're now back below both the 20-week and the 50-week. So after looking really strong, we now have lost the moving averages, which tells me we're more in consolidation, sideways consolidation, rather than uptrending or downtrending. When you have this many tests, failures on the key moving averages, I mean, here we kind of held, then we didn't on the way back up, then we didn't on the way back down. And I mean, we just keep moving up and below the moving averages. That just tells me right now, Apple is trendless. It peaked at the end of 2021. It's sideways consolidating. Until we get that breakout above 180, 181, we're in consolidation mode. Do we go back to the low? I wouldn't think so, but it's possible. If Apple goes back to the low, there's not going to be anything much keeping us from that June bottom, maybe even below it. So yeah, I mean, Apple is a big part of what we're looking at here. And so we definitely want to keep an eye on Apple. Another is Microsoft, obviously, Mr. Softy. Maybe not quite as strong as Apple in terms of its rebound. Never got through its 50-day, but it did go through the 20. Now it's pulled back and getting closer and closer to those recent lows that were set back in June. near the 240 level. We're not really that far away here. A couple more bad days, Microsoft could be there. Google, another one, key stock to watch. This one, internet stocks have just been so weak. And I remember talking about Google back over the summer, maybe into the early fall of last year. And this move right here reminded me of Amazon when Amazon made its big move a while back. I'll pull that one up in just a second. But at the top here, we had higher PPOs all the way until we got to November. When you get a negative divergence on a weekly chart here, that's definitely a negative. But if you're paying attention, if we go to a lower low, we're going to have a positive divergence on the weekly chart, which is a good thing. So I think we're, like I said, we're either at or close to a pretty significant bottom. I think we set it in June. But for Google, I mean, we're going to see a lot more of these positive divergences setting up if, in fact, we go back and test recent lows on many of these stocks. So keep that in mind. But this huge move right here was more than a triple. I mean, we were at 50 and we went, well, about a triple from 50 to 150 in 18 months. That's too much for any stock. And so you get to this period and then you have a negative divergence. And I said, Google could experience what happened to Amazon. So here's Amazon. And Amazon, first of all, went through this long period. Let's go back, just go back 7 years. But Amazon, look at this stretch Amazon had, going from, I don't know, 20 to 90 in a little more than 2 years, maybe 2.5 years. But at the top, negative divergence. And look what Amazon had to deal with for the next 18 months. The stock market kept going higher, but Amazon didn't. So it just took a while to get the next move going. Then, of course, struggled for a while and rolled back over again since then. But anytime you're in a stock that goes up for an extended period of time and it just goes up so much, you've got to be somewhat cognizant of that and just be willing to accept that a period of consolidation is likely to hit. And that's what I think is going to go on with Google for a little while. And that's what happened to Amazon. Tesla, another big name. I'm just seeing sideways consolidation. Tesla's held up pretty well relative to what's been going on in a lot of other stocks and what's been going on in the market. But it too is right back down right now, just below its 20-week moving average, just $1. But again, down, test the 20, bounce, below the 20, above the 20, below the 20, below the 50, above the 20, above the 50, back down below both. It's consolidating. It's trendless right now, trying to wait for direction. And we just don't have that. So just looking at that, I think will give you a sense of what the market is facing right now. These are some of the biggest stocks. These are the stocks, if you're going to turn back to the upside in a big way, these are the stocks that have to do it. And their charts are just blah at the moment. They're not, I wouldn't say that they're all horrible, but they're just not, they don't look like they're ready to take off either. And so I think we have more of this back and forth yo-yo, high volatility, whipsaw market. And I think it's probably going to carry on through this month, maybe into early October. We'll see. It'll be interesting to see when the next PPI and CPI reports come out, which is next week, how they come out, because this is what the Fed's looking for. The Fed wants to see more than 1 month. What will happen if we get 2 months of stable, and non-inflationary, even deflationary type of readings? Because I've said recently, that's one of the things I'm worried about with the market. I'm not as worried about inflation as I am deflation. And the reason I say that is if you keep raising rates and you keep lowering demand, and at the same time, all of our supply chain issues are catching up, low demand, increasing supply. We've seen the last 2 months of inventories rise 1.5% each month. Those are big increases in inventories. And the Fed is talking about continuing to raise rates. At some point, you got to sell these goods. And if demand's down, how do you sell them? You got to start lowering prices. So I think the bigger picture issue is going to be deflation, not inflation. And I think by the end of the year, we're going to be hearing more about that. But for now, it is what it is. And I think as long as the Fed stays on its current path, and hey, feel free to disagree. This is an open debate. Everybody has different opinions on it. I just have one opinion, mine. And I think that they're making a mistake, but time will tell. I agree they have to fight inflation. Don't get me wrong. Inflation is worse than a recession. Inflation can be debilitating for many years. We know that from the 1970s. So I understand, but we also didn't have a pandemic heading into the 1970s. We had other systemic issues. We didn't have those in 2020, 2019, or at least not as much. Anyway, I'll stop that for now. One other thing I want to talk about before we wrap up, and this is something I've been wanting to show everybody. If you're not familiar, and then by the way, the market did just open, NASDAQ up 13, Dow down 46. We'll see what happens here over the next couple of minutes. I just wanted to point out on this dashboard, I've got things set up where, well, we're waiting for the market movers and scooters. Actually, I don't know why this one's on. Anyway, if you go to your dashboard, this is probably one of the biggest things over here. They call it the gear shift or the gears. If you click on this, it'll tell you what panels you have on your dashboard and which ones you want. You can click on chart list panels, chart panels, commentary, if there's blogs or something that you want to follow. But this is pretty cool because you can set up your dashboard however you want. Now, if I take off this additional data panels and click save, then all of a sudden they're gone. The scooter reports and so forth I just had here are no longer here. So what you can do is set this up, and then you have your market movers. You can change this to whatever you want to see. Sector summary, what's leading the action. There you go. If you want ticker cloud, I don't usually use ticker cloud, but the bigger the ticker symbol is, the more that it's requested at stock charts. So you can get a sense of what other people are interested in. And you might find stocks that are on the move that you weren't even aware of. So that's an interesting one. I usually set mine to the scooter reports. And I usually have large cap, mid cap, and small cap set up. So it's just telling me, and then I can look at what's moving. So maybe if I want to see what's really moving to the upside, you can do this top up. This tells you the change today, which ones are really moving. So it could be news. I mean, especially on some of these small caps. I mean, that stock was $1.16 and now it's $1.48. But as you go down here, you'll see some of these. So if you really like these small ones that are starting to move, it's a great way to look at it. Anyway, I just think it's a really cool feature that Stock Charts offers everybody. And, we'll see what, you can set it up however you want, based on how you view the market. I think it's pretty cool. All right. So the 3 you must see, I always like to finish with the 3 you must see. Well, let's look at the 3 leaders on the S&P 500, Twitter, Tractor Supply, and Starbucks. See what's going on. All right, Twitter, well, it's moving back up again, but it's really below its moving averages. I think it's got some issues up around the $40 level. $39.80 now. We'll see if we can get through. If you get some volume and break above these moving averages, maybe. But this stock, personally, I wouldn't trade it. It's just had so many ups and downs, crazy gaps up, you think you got it on the move here with the Musk deal, and then the Musk deal falls through. And I don't know, Twitter has just been one that, you can make a lot of money if you get it right, but you also can lose a lot of money. Second one was Tractor Supply. I see just sideways consolidation, 182, 183 support, 206, 207 resistance, and we're about in the middle of the range, maybe a little bit toward the lower end of the range, but it's got to get through the 20-day first, although the moving averages really aren't doing a whole lot. This is more of a trendless. See how the stock keeps going up above the 20 and below the 20, and look at the 20 versus the 50, how it keeps crossing. So you got a golden cross, death cross, golden cross, death cross. Now it's turning back up again. If you're trading based on these crosses, you're getting whipsawed and you're losing money. So you need to recognize when you start seeing a lot of these moving average failures and just chalk it up to trendless. It is a trendless stock. And I'm a momentum trader. I do not want to trade trendless stocks. I want to trade trending stocks or stocks that I think are about to turn and trend. Last one, Starbucks. Nice move off the 50-day. Starbucks getting a nice little run here. Yesterday's volume was picking up too. Key support around this area. This is one that I think is starting to look much, much better. PPO turning at the center line back up. I would just say if it loses 82.5 on a close, reevaluate. But otherwise, I think Starbucks actually looks pretty good here. All right, that's it for me. Let's get a quick update again on the market. See if anything's green. Well, NASDAQ is up 43. That's not bad. S&P up 4 points. So still holding on to 3,900. Dow flat. I would honestly, I'd rather see the market down in the morning and rebounding and strong in the afternoon. I will be more bullish the market in the short term when we finish a day at or near the high. Until we do that, I'm going to have my guard up, especially as I mentioned earlier with the VIX going up, the market trending lower, 7 straight down days on the NASDAQ. You got to be careful in this market on the long side. You know, if you take a chance, I would be really careful if by the end of the day you haven't seen a reversal, if you haven't seen much movement to the upside, because we know what can happen at the opening gap and in the early morning hours. It's what I've been pointing out just consistently here over the last couple of months. So be careful out there. Let's see how the market finishes the day, and we'll go from there. Everybody have a great day and happy trading.